So when we talk about shares and stocks, what do we mean? So let's move into it. That's what we want to discuss in Module 4. A stock is a collection of shares in one or more companies, while a share is a single unit of ownership in a company. Let me break it down. When we talk about share, a share is a unit. A company is divided into shares. Let's say at the point of dividing it is divided into, let's say, 1,000 shares. For instance, when you are buying a piece and a piece is going for, let's say, 10 naira, you are buying a piece for 10 naira. Now, which means the total value of that company is the number of shares times the amount being sold per share. So in this case, we have 1,000 shares multiplied by 10 naira per share, which is how much? 100,000. So that is the value of that company. So when you are buying a share, 10 naira, you are owning a piece of that company. So when we now talk about stock, we are talking about collection of shares in one or more company. So you see that some people use it interchangeably. They say stocks, they say shares, but technically this is the difference. Technically, accounting wise, financial wise. So it is not something that you should cram, but it's just something that you need to know that, okay, because some people are confused. What is really the difference between shares and stocks? When we talk about shares, we are talking about a unit ownership, but when we are talking about stocks is a collection of shares. So which means when we talk about shares is a portion of your stocks, while stocks is a collection of your shares. Shares is a portion of your stock, while stocks is a collection of your shares. Let's move on. When we talk about stocks investment, so what is stock investment? A share is a unit of ownership in a company, and buying shares makes you a shareholder and part owner of that company. It makes you a part owner. Now you are also part of the owners. So when they say, oh, when you buy shares of, let's say, Zenith Bank, or you buy shares of GT Co, or you buy shares of First Bank, or you buy shares of Aradel, you buy shares of Kutix, you become a part of the owners. You become a shareholder. You are also part of the owners of those companies. So which means you have the right to vote on certain company decisions when they want to make certain company decisions during their annual general meeting, which comes up once in a year. You have the right to vote because you are also part of the owners, and they may receive dividend and capital appreciation. So you need to understand that there are two major ways. There are other ways, but two major ways how you make money through stock investments when you are investing in shares. Number one is through dividend. Number two is through capital appreciation. When we say dividend, it means the company giving you part of their profits, and it is shared yearly. So, and when they usually declare interim dividend, which means part dividend. And some companies pay dividend 4 times in a year. In Nigeria, for instance, 4 times in a year, while some pay twice. For instance, major banks pay twice in a year, while some companies pay once in a year. And we have companies that don't pay at all. They don't pay dividend. So you need to understand, and in the coming modules you'll be understanding what to look out for when investing in this company. Are you looking for a company that pays dividend, or you are simply interested in a company that you have capital appreciation, or both? When we now talk about capital appreciation, I said there are two ways of making money in the stock market. When you invest in stock or shares, number one is dividend, which means they declare part of their profit as dividend. They declare. So you look at the capital appreciation, which means when you are buying a share, let's say at 10 naira per share, 10 naira per share, but in a year time it has now become 15 naira, which means your 10 naira suddenly becomes 15 naira. Or you bought a shares at 20 naira, and in 2 years time it has become 40 naira. That is appreciation. You are not going to be given that surplus on it. You are going to have that surplus when you sell that shares, because you bought it at 20 naira, now it is 40 naira per share, which means you have 20 naira gain on it. 40 minus 20 making 20 naira. So that when you now sell it, instead of having 20 naira, you have 40 naira per share. Now imagine if you have 1 million shares. I hope you get the mathematics. So that's how you make money. Is either through dividends or you make money through capital appreciation, or both. So many companies, they do what? They pay dividends, and also their share price also increases in value. I hope you get my points. So let's move to types of stocks. Types of stocks. Number one, we have dividend stocks. Dividend stocks are stocks that distribute a portion of their profits to shareholders on a regular basis in form of dividends. They distribute a portion of their profits to shareholders on a regular basis in the form of dividend. So probably, let's say they made 1 million naira, they could say, okay, out of this 1 million naira, we are going to replow, let's say 700,000 naira into the business, which we call retained earnings. The remaining 300,000 naira, let us share it to our investors. So that is what we call dividend. So when you go on their income statement, you see something called bottom line item, which is the net profit. So out of that net profit, they could say, okay, we made a 1 million naira profit, we are replowing 700,000, the remaining 300,000, let's give it to our investors in form of dividends. Dividend stocks are also known as income stocks, and they are suitable for investors looking for regular income. So if you are looking for regular income, your own is not majorly capital appreciation, your own is to have regular income. You may be looking for a company that pays dividend 4 times a year, and you may decide to invest in such a company. So whether the share price increases in value, it is not so much of a concern for you. What is of a concern for you as a dividend stock investor is the amount of dividend, or how frequent they pay dividend in such a company. So your main target when investing is the dividend that they pay. You look at ratios like dividend payout ratio, look at dividend yield. These are what you look at. You look at DPS, dividend per share. These are the ratios look at. These are the metrics you look at when you are a dividend stock investor. You are looking for regular income. This is one of the stocks that people who are planning towards retirement should look at in order to supplement their pension, or people who want other multiple streams of income. They want to complement their income, they can look at dividend stocks. They typically have lower volatility and less capital appreciation than growth equities. They typically have low volatility. So one thing about dividend paying stocks is, unlike some stocks like growth stocks or value stocks or penny stocks, we are still going to get them. I'm still going to explain all those ones too, where you invest 1 million naira and you have a drawdown, or you have a dip, a pullback, and your 1 million naira suddenly becomes 600,000. For dividend stocks, it's not like that, because most companies that pay dividend like this, they are stable company. So they have lower volatility, because a major responsibility that these companies intend to fulfill to their investors is to pay dividends, not necessarily to grow their share price, because they are already established companies in the economy. I hope you understand. If you have further questions, you can drop it in the comment section below. We have the growth stocks. Growth stocks. These are stocks of companies whose sales and profitability are rising quickly. They have the potential to grow. A growth stock is any stock that is anticipated to grow at a rate significantly above the average growth for the market. Maybe the market is expected to grow at, let's say, 20% per year, 30% per year. But you can see this company, maybe is, just imagine, some people saw Presco, Okomo Oil years ago, and they saw that this market, looking at it, is going to boom. It has a future. A growth stock has a future, but currently, maybe due to microeconomic factors, They are not performing so well. Looking at the macroeconomic factors, they are just coming up. They are just coming up. So you can see their profitability. You are looking at it. In the advanced class, we will be talking about factors to look at. In the advanced class, we are not is not within the purview of this class, of this course 1.0, to talk about what are the indicators to know the growth, to know growth stocks. Promising growth stocks are companies with strong and increasing customer demand. Let me give you an example. If you see a company, for instance, that is into tech, what happened? There is increasing customer demand for tech. That's why you see, for instance, let me cite a foreign company that's into tech that skyrocketed last year, which is Nvidia, because of AI. AI is now becoming more and more in demand. People are demanding for it. Solar as well. Solar technology. So if you see any company that is, because the growth, the demand is high for it. Electric cars, that's why you see a company like Tesla jumping up, even though due to macroeconomic issues, it's plunging now. But you know that it's a company that has growth potential, especially when there is a projection for a long-term preference for their products and services. There is a projection for a long-term preference. You know that in the next 10 years, the demand for the product of this company is going to be in high demand. It's going to be at a high level. You go for such. Number 3, value stocks. Value stocks are shares of companies that trade below their intrinsic value based on fundamentals like earnings or sales. When we talk about value stocks, we are talking about stocks that are currently being undervalued. Maybe due to macroeconomic factors, but looking at their fundamentals, looking at the kind of business they are doing, you know that this business is currently being undervalued. By the time we look at the intrinsic value of that company, we can see it is bare, it is obvious to investors that this is a value stock. The ratios we are going to be looking at, we'll talk about it in the advanced class. And the advanced class is coming with 3 months mentorship. 3 months mentorship where we hold you by the hand how to invest, what to look out for, where you also become a pro, at least to an extent, in the 3 months. We have a community where we are going to train you. And we also have an access to our private session videos, where you will be able to learn, you will be able to make analysis yourself, fundamental analysis and technical analysis. These companies are often well established but temporarily undervalued by the markets due to some fundamental factors, or even microeconomic factors. They are thought of as traditional, well-known businesses that have already become market leaders and need more room to grow further. So those are value stocks. Blue chip stocks. Blue chip stocks are stocks of companies with lower liabilities, reliable earnings, and a history of dividend payments. They are well-established businesses. Well, the ones that we know. Let me give you an example. Dangote Cement, Nigerian Breweries, MTN Nigeria, they are well established. Those are the ones we call blue chip stocks. So some investors prefer blue chip stocks because they are well established. Their level of volatility is moderate. There's nothing called going high, coming low within a week, dropping to the barest minimum. No, they are well established. Investors looking for safer investment options may choose these huge, well-known corporations with a huge financial performance track record. Dangote Cement, Nigerian Breweries, and MTN Nigeria are a few examples of blue chip stocks. I hope you are getting value. If you are getting value, drop it in the comment section below that I am getting value. Then we have penny stocks. Some investors prefer penny stocks. A penny Penny stocks are stocks of a small public company that is traded at a low price, usually below 5 naira per share. Penny stocks are prone to high volatility due to low liquidity and trading volumes. Penny stocks can therefore provide an opportunity for large, quick gains because a small movement in the price of a penny stock can produce a large percentage gain, but they also carry significant risk compared to more established stocks. So you need to understand this. When you are buying penny stocks, when you are investing in penny stocks, you can quickly make money, and also you can lose money, unlike established stocks like blue chip stocks. For instance, last year 2024, there is a penny stock called Julie PLC. It did over 1,000%, which means if you invested 1 million naira, at the end the 1 million naira would have become over 16 million. But a major issue penny stocks have at times is liquidity. You may want to sell that 16 million naira stock and not be able to sell. You may not be able to see by buyers, so you now have to sell in piecemeal. So you can see low liquidity and trading volumes. You may not be able to. So those are the issues that comes. Those are just the drawbacks that comes with penny stocks. But if you are looking for stocks that can do massively well in the markets, penny stocks is a go-to. But also know that it carries significant risk. I hope you are getting value. I hope you understand penny stocks. Defensive stocks. Defensive stocks are favored during difficult market conditions since they are mostly unaffected by economic circumstances. These are, when we talk about defensive stocks, we are talking about they are favored during difficult market conditions, even when other markets are plunging. Just imagine during COVID, what happened? Hotels, travels and tours, those industries, banking, they were what? They were all affected. But food and beverage, healthcare, what happened to them? Communication services, they stayed afloat of that recession, of that period. So those are defensive stocks that come what come with, there will always be demand for them. Food, beverage, health. People cannot joke with their health. So these are industries, these are stocks that has to do with the basic needs of men that people cannot do without. The products, the business will always be in demand. So defensive stocks are often perform consistently or even better during market meltdown or recession. These stocks are frequently considered to be a safe haven assets. Food and beverage, healthcare, and communication services are typical examples. In the next module, we'll be talking about preparing to invest, essential steps, and resources. If you are yet to subscribe to this channel, kindly do by clicking on the subscribe button and click on the notification bell so you can be notified whenever we release a new video. On this channel, we talk about finance, investment, and business. Till we meet in our next video, stay blessed.